Hi, Michael Kolb, CFP with Evergreen Wealth Solutions here for you with your 2023 market update. 2023 was a pretty good year for markets and bonds. The S&P 500 was up over 26%, but this does mask a little bit of a differing or a dispersion of returns that happen amongst the markets. Your blue chip Dow Jones Industrial average was up only about 16%, while your tech-heavy NASDAQ was up almost 45%. And this held true across different market capitalizations as well as areas of the market. Earnings were also incredibly positive for the end of third quarter. They went up 4.5% when it was expected to have a decline of about 1.25%. International markets also ended up for the year, up about 18%, and emerging markets were also up about 10%. And all of these indices also ended up above their 200-day moving average, which from a technical perspective is very positive. So what happened in fixed income markets? Well, they were pretty good too. They were supported by falling interest rates. The 10-year Treasury dropped from 4.3% at the end of November down to 3.88% at the end of December. This was very, very positive for bonds in general, particularly longer duration bonds, which helped the Barclays Aggregate Bond Index end up over 5.5% for the year. In addition, the high yield index was up about 3.3% for the year, but there was an increased appetite for these riskier assets, which can be concerning from a contrarian perspective. When it comes to the economy as a whole, December was a great month. It painted a great picture of continued economic growth into the new year, accelerated hiring in November with better than expected jobs at almost 200,000 during the month. There was also a rebound in consumer confidence in December, which led to increased consumer optimism and consumer spending. Much of this was led by the lower inflation. We went from 9.1% inflation in June of 2022 whole way down to 3.1 in November of last year. That really helps consumers feel confident about spending, which then stimulates the economy. So what do we have to look forward to? Well, the most important thing for us, what we're watching in 2024, is the Fed. The Fed has said, hey, the market's doing well, inflation's starting to cool. And so one of the things we need to watch is how many rate cuts, or if any rate cuts, they may have this year. The issue here is that the market is pricing in 6 rate cuts, and the Fed has indicated 3. So the market could be overestimating the Fed's willingness to cut these rates, and that could be a negative for markets, but we want to monitor this closely. In addition, you also have our domestic risks of the election. Typically, election years are a lot more volatile, albeit not bad in terms of performance. We also have our European war and our Middle Eastern war, and there's other geopolitical risks that are happening as well. So what is the takeaway here? Well, there's a lot of risks that do still remain. We all are aware of that. And there's going to be a lot of headlines coming into the year, whether it's with the Fed or with the elections. But market fundamentals and market technicals ended the year on a pretty high note. And those should be pretty supportive going into the new year. Additionally, the economic fundamentals are showing signs of a healthy, expanding economy, which really should also help the market throughout 2024. The real risks here do remain, though. Inflation, the Fed, the geopolitical risks, the election, all these things may develop throughout the year, and particularly the things that we just can't anticipate. But we really want to point to the fact that intra-year declines happen regularly. If we look back at 2023, we had a really nice positive return at the beginning of the year. And then the market dropped pretty substantially, and a lot of people became pretty pessimistic. And then we had a nice rally at the end, and so most people's perspective was changed yet again. But this is actually incredibly common. If we look back to 1980, intra-year price 500 was 14.2%, but yet it still ended the year on average up over 9%. So we need to expect those kind of intra-year declines when we're investing in stocks. And this held true in the S&P 500 in 2023, it came down about 10% from its peak to its trough, but ended up the year up 26%. So there is this volatility in equity markets, and there is the potential in going into a year like we are having with the elections of having additional short-term uncertainty in the markets. But this is when a well-diversified portfolio shines. We saw that happen in 2023 with bonds really holding up the portfolios when equities weren't doing as well, and vice versa. So if concerns remain with you, if you weren't able to handle 2022, then maybe talk to your advisor about your risk tolerance. But for most of us, we have a long-term perspective with our goals in mind, and we can understand that the markets are turbulent. we can also know that markets do typically end up positive over the long term. Any questions, please reach out to us. We'd love to talk to you and get to know you a little bit better than we already do.